In this video, I am going to share with you what's causing Singapore REITs to drop and if you should be worried. Let's get into it. Hey friends, welcome back to the channel. I'm Iggy here, and I've been covering topics about stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads. I've covered over 500 videos and reached more than 250,000 watch hours as of September 2024. The bond yield story. The REIT market has been experiencing some changes lately. In September, the U.S. Federal Reserve cut interest rates, leading to a decrease in Singapore's 10-year government bond yield to 2.40%. However, it has now increased to 2.90%. This surge is primarily due to the unexpected strength of the U.S. economy, which led to a shift in expectations regarding future rate cuts. Additionally, the recent news of Donald Trump's election victory has further contributed to the rise in bond yields. Investors are now concerned that his policies may lead to higher inflation, which in turn affects REITs that are sensitive to interest rates. REITs are currently trading close to their 3-year average PE ratio, and the 3-year average PS ratio is higher than the industry's current PS ratio. However, earnings for companies in the REITs industry have declined significantly over the last 3 years, and revenues have also declined. Despite these challenges, some industries within the REIT sector are expected to experience growth, such as the healthcare REITs industry, which is forecasted to see annual earnings growth over the next 5 years. On the other hand, the diversified REITs industry is expected to see its earnings decline over the next few years. Office space blues. The recent addition of the IOI Central Boulevard Towers, boasting 1.26 million square feet of upscale office space in the Central Business District, may not be the cause for celebration that it initially seems. Office vacancy rates have taken a significant leap, surging from 7.9% to 10.3% in merely 2 quarters, resulting in a substantial amount of unoccupied space. This trend is further exemplified by Suntec REIT's experience with their premier properties, unravels Quay and MBFC Towers, which are witnessing a slowdown in rent increases. While they still managed to achieve a 6.8% rise in rents this quarter, this figure pales in comparison to the 14.4% increase seen last year, indicating a clear cooling off of the office rental market. This shift in the market dynamics may have far-reaching implications for investors and businesses alike. As office vacancy rates continue to climb, landlords and property managers may be forced to reassess their rental strategies and consider offering more competitive rates to attract and retain tenants. Conversely, businesses seeking to establish or expand their operations may find themselves in a more favorable position to negotiate leases that better suit their needs. Amidst this changing landscape, it remains to be seen how the office rental market will evolve and stabilize in the long run. Retail's silver lining. Despite the office space blues, there's a silver lining in the retail sector. Retail REITs are showing resilience, with island-wide prime retail rents experiencing a notable 4.1% increase compared to last year, reaching $26.95 per square foot. The iconic Orchard Road is faring even better, with rents rising 4.8% to $37.45 per square foot. This upward trend is a welcome change from the 14% vacancy rate that plagued Orchard Road just last year, which has now decreased to 7%. This significant drop in vacancies suggests that retailers are regaining confidence as tourism continues to recover. And recover it has, with Singapore's tourism receipts surging 19.6% in the first half of 2024, reaching an impressive $14.9 billion. The return of Chinese visitors is a key driver of this growth, injecting new life into the retail scene. As the retail sector continues to gain momentum, it will be interesting to see how this resurgence impacts the overall economy and consumer sentiment. Industrial REITs, storm clouds ahead. The industrial sector, once a stalwart of the REIT landscape, is now exhibiting some troubling signs. Rent growth has slowed dramatically, creeping up by a mere 0.3%, the most anemic pace since late 2021. Moreover, certain subsectors, such as business parks and single-user factories, are already experiencing rent declines, hinting at a broader softening of the market. What's particularly concerning is the looming oversupply situation, with a staggering 1.6 million square meters of new industrial space slated to flood the market in 2025. This represents the largest influx of new supply since 2017, far outpacing the average annual demand of approximately 0.5 million square meters. Basic arithmetic suggests that this imbalance will inevitably exert downward pressure on both rents and occupancy rates, casting a shadow over the industrial REIT sector's prospects. As the market prepares to absorb this substantial influx of new space, investors and stakeholders would be wise to exercise caution and closely monitor the evolving dynamics. What should you do? So, what's an investor to do in this uncertain climate? As your trusted advisor, I recommend exercising caution and being highly selective with your REIT investments. The current environment, marked by high bond yields, may pose significant challenges for some REITs to sustain their distributions. In fact, certain REITs may struggle to maintain their payout levels, making it essential to be discerning in your choices. My advice is to keep a watchful eye on REITs that have demonstrated the ability to proactively manage their portfolios with a focus on enhancing their distributions. These REITs, with their robust asset management strategies, are better equipped to navigate the prevailing headwinds and potentially offer more resilient returns. By being picky and focusing on REITs with strong portfolio management capabilities, you can make more informed investment decisions and position yourself for success in this challenging market. If you enjoyed this deep dive into Singapore REITs, you're going to love my video on Singapore's best quarterly REITs, where I analyze the top performing REITs for this quarter and share exactly why they're outperforming the market despite these challenging conditions. I'll show you which REITs are still delivering strong distributions and maintaining high occupancy rates even in this high interest rate environment. You'll learn which sectors are showing the most resilience and which REITs have the strongest fundamentals to weather this storm. Check it out in the end screen. It's the perfect companion to today's analysis.